Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. Well, another week, a few more record highs for gold. You know, when I started recording the show last week, so basically almost exactly a week ago, gold was at $3,562 an ounce. It closed yesterday at $3,639 an ounce. That's a 2.2% gain in just 1 week. The yellow metal actually traded higher than that yesterday morning. I saw it as high as $3,680 an ounce. You know, it's a pretty staggering bull market. Now, don't be shocked if you do see some selling this week. Healthy bull markets never go straight up. There are always corrections and consolidations along the way. As the saying goes, bull markets climb a wall of worry. But Jesse Colombo, he's a technical analyst, and we publish his work over at moneymetals.com/news. And he argues that we shouldn't be worried about a major correction, and we shouldn't get all panicked. He wrote, quote, "Amateur investors and wannabe analysts are panicking over gold and silver being overbought, without realizing that persistent overbought conditions are a hallmark of every strong bull market. Many are suddenly panicking and calling for a correction in both gold and silver. I've also been inundated with worried messages and comments asking if precious metals are about to plunge. The typical claims are circulating again. Gold has risen too far too fast. It's overbought. It's too expensive, and it must be due for a correction. Some are even calling the bull market a bubble. What's striking is that most of these critics failed to foresee the gold bull market over the past 2 years, yet they are now quick to dismiss it. Whether they are motivated by envy, fear of missing out, or simple ignorance, their arguments are deeply flawed." And so Jesse goes on and he offers some in-depth analysis to back up his assertion. And it's definitely worth checking out. I'm not going to read the whole article to you. You can read it yourself over at moneymetals.com/news, and I will link to that on the show notes page. And it would be especially a good read if you've kind of got this anxiety that, you know, this is too good to be true and the market's about to crash. But as I said, I do expect to see some selling and consolidation. That's normal, right? But as I explained last week, the fundamentals supporting this bull rally are still in place. In fact, a round of consolidation after the last big run-up in April was far less than you would typically expect based on historical analysis. But anyway, I don't really want to talk about gold today. I want to focus on the other bull market, and I'm talking about silver. But before I get into that, I want to just take a moment and thank you so much for listening to the show. And you know, I say this at the end of the show all the time, but I really do appreciate the fact that you folks take a little bit of time out of your day to spend it with me, because I know there's a lot of stuff out there that you can listen to. Now, I'm going to ask you to do me a favor. Obviously, we don't charge you anything to listen to the show, right? We don't ask anything of you, but if you could do me this favor, I'd really appreciate it. Go to wherever you listen, whatever podcasting platform you're on, write a good review. Give us those 5 stars. Give us those thumbs up on YouTube, and share these episodes around. That's how we can grow the show and make it better. So if you would do that, I would say a great big thank you. So anyway, let's talk about silver. You know, it's kind of been in the shadows of gold for 2 years now, right? Gold keeps setting record after record, new high after new high, and yet silver is still below its twin all-time highs around $50 an ounce that were set back in the 1980s and then again in 2011. That said, silver isn't quite the slacker that some people seem to imagine. Silver is actually up an impressive 39.7% so far this year, and it's hit the highest level since 2011, which was, again, the last time it made a record high. It has broken through the significant $40 per ounce resistance and appears to be on track for a new record high of over $50 an ounce. In fact, we've had pretty good support around $41. And a lot of the analysts that I've talked to have said that, that $40 level was really key. And once we hit that, it's kind of a free run up to $50. So we'll see, how that plays out and when that happens. But that's what the charts look like anyway. But if you are bullish on the gold rally continuing, you should be even more bullish on silver because it appears to have even more room to run up than gold. And one of the metrics that I use to kind of watch silver is the gold-silver ratio. And I've talked about that ratio on the show before. I'll link to an article on the show notes that kind of gives you an overview on it if you want to get a little bit deeper into it. But basically, the gold-silver ratio is just how much gold it takes, or how much silver it takes to buy 1 ounce of gold. And right now that ratio is still over 88 to 1. And this indicates that silver remains a bargain compared to gold. In the simplest terms, the ratio reveals the price relationship between the two metals. And that price relationship, within bounds, tends to remain relatively constant. There's similar assets. They tend to move together, although not completely. Silver's more volatile. Its price fluctuates up and down a lot more than gold. But over the long term, they do tend to move shoulder in shoulder. So as I already mentioned, the gold-silver ratio represents the amount of silver it takes to buy an ounce of gold. In the modern era, the gold-silver ratio is averaged between 40 to 1 and 60 to 1, kind of on the higher side of that. So let's say around 60 to 1 as the average. When the gold-silver ratio gets above that level, it tends to snap back quickly to the mean. And that typically happens when the price of silver rallies to close up that spread. So you'll see gold move up, up, up. That spread opens. It takes more and more silver to buy an ounce of gold. And then at some point, there'll be an inflection, and silver will make a very fast run up to close that gap and bring it back into that average. Now, some people claim that the ratio is broken down and it's no longer a good gauge. I've had a lot of people tell me that. And I think part of that's because it's been wider than average for quite a while. But the fact of the matter is nobody has really explained to me why it might have broken down, right? Give me a reason. I mean, don't just say it's broken down because it's been historically wide for a long time. That doesn't necessarily mean it's broken down. If it has, there should be a reason. I kind of just think they say that because it's been wide for quite a while, right? More than 2 years. But you have to remember that economic trends tend to play out on longer timelines than most people think or realize, especially in this day and age. I really think, I've been talking about this a lot with people I know and my wife. We have a distorted view of time, right? 2008 seems like an ancient history to a lot of people, right? Most people are operating on a time horizon that quite honestly is dictated by the latest posts on X. And you're going to miss a lot if you can't step back and take a longer view, look at longer trends, right? I'll give you an example. Jim Grant has been talking about a secular bear market in bonds. And he has pointed out that these cycles in the bond market tend to play out over not years, but decades, right? So if you're just looking at the last 2 or 3 years, you're going to have a misguided view of what's going on, right? If you just, if ancient history to you is 2008, then you think 0% interest rates are normal. That this low interest rate, below 1 or 2%, that's the way it should be. No, that's the anomaly. The last 2 decades have been the weird ones, right? Where we've had these 0 and 1% interest rates. That's not the norm. That's not typical. But a lot of people don't recognize that. So anyway, we've seen this phenomenon play out with the gold-silver ratio as recently as 2020. So if it has broken down, it's been in the last 5 years. Back in 2020, the gold-silver ratio actually set a record. It got as wide as 123 to 1. And that was as COVID hysteria was gripping the world. And then that ratio plunged to around 60 to 1 as the central banks around the world cranked up the money creation machine to cope with the stupid governments shutting down their economies for the virus. So from its June 2020 low, silver gained 80% in less than 20 weeks. And it closed that gap back to that average. We saw a similar snapback, but it was actually even bigger during the Great Recession. The gold-silver ratio dropped all the way to 30 to 1 during the aforementioned run to that record high in 2011. So from a historical perspective, when you see gold-silver ratios well above the historical averages, it tells you that silver is underpriced compared to gold. That is the case today. That means there is a strong possibility that silver will go on a bull run to close that gap. And historically, this has often happened in the midst of a gold bull rally, right? With silver outperforming gold. Now, we always say this, it's almost a joke in the investing world. Past performance does not guarantee future results, and that is true. The gold-silver ratio might have broken down, right? There could be some other factor that would not have history play out the way it has in the past, right? Again, maybe the gold-silver ratio has broken down. But until somebody can give me a good explanation as to why this would happen, or to show me some dynamics in the market to explain why we shouldn't expect history to at least rhyme, I'm going to stick with the historical precedent, right? That's why we do technical analysis to begin with, right? Things follow patterns. That's just, it's human, it's part of human nature, it's part of the way of the world. So, with all of that said, point being that silver right now is underpriced compared to gold from an historical standpoint. That would indicate that we have silver on sale. What is driving this rally in silver? Well, a lot of the macro dynamics are exactly the same as those that are driving the gold market, including the expectation of Fed rate cuts. We've seen this pivot to safe havens. There's inflation worries out there. We've seen a lot of weak economic data. People are suddenly worried about jobs. We have a weak dollar. We have de-dollarization going on. All of these things are contributing to the bull market in precious metals in general. I covered all of that in depth last week, so I'm not going to go into it again. If you haven't listened to the show last week, make sure you give that one a listen because it's going to give you some good background and some good macroeconomic foundation for the gold market that applies also to the silver market. But there are some things specific to the silver market that I want to highlight today beyond these kind of macro factors. First off, silver's playing follow the leader, and this is typical. And I've kind of alluded to this in my discussion of the gold-silver ratio. Silver has historically lagged behind in a gold bull market. It tends to make its big move close to the end, right? As we get later into it, or as the bull market matures. I wouldn't necessarily say the end, but as that bull market matures, that's when silver tends to make its move. In fact, silver often outperforms gold in a gold bull market. This happened in the 2008 to 2011 bull market. It also happened during the pandemic. So as gold continues to charge upward and set new record highs, it's dragging silver up along with it, right? Silver hasn't made that run that it typically does as the bull market matures, but it is being influenced by the gold market, and it's being pulled up along with its big brother. More fundamentally, though, and I think this is really important, we've talked about it on the show before, but I want to kind of go over it again. Silver is getting a boost from tight silver supplies, particularly right now. There's this decline in liquidity in the London market. And of course, the London market is extremely important in precious metals, probably, arguably, the most important center of bullion trading, both for silver and gold. Now, we could argue that the Shanghai exchange is maybe playing catch up, and we're starting to see much more influence from some of these centers in the East. But by and large, London, is kind of the big dog out there. So we started to see this phenomenon last summer when tariff worries drove a significant amount of metal out of London and into the United States. We've talked about this with gold pretty extensively. I think I did a show on it back when it was going on. I know I've written several articles on the phenomenon. But it also happened with silver. According to Metals Focus, which is a really good organization that basically analyzes data relating to the precious metals market. And according to Metals Focus, although silver was confirmed as being tariff exempt in April, lingering trade uncertainties in particular seem to have limited the return of silver to London. So we had this big influx of metal out of that London center, out of those London vaults. And it's still sitting over here in the United States. A lot of that has not returned yet. And all of this occurred, and I think this is really kind of what made this more significant than it otherwise would have been, is that the silver supply environment was already very tight. Demand outstripped the silver supply for the fourth consecutive year in 2024. The structural market deficit came in at 148.9 million ounces. So what I'm saying here is that the industry and the users of silver used 148 million ounces more silver than was mined or recycled. So that drove the four-year market shortfall. The four-year market shortfall, say that 4 times fast, was 678 million ounces. And that's the equivalent of about 10 months of mining supply in 2024. So we're talking about significant supply deficits. Now, that doesn't mean that there was no silver, right? When demand outstrips mining and recycling output, industrial users and jewelers and folks who are making stuff out of silver, they are forced to wade into the market to access existing stocks of silver that are already above ground. So we're talking about silver bars that are primarily in the hands of investors. And in order for them to get those people to let go of those silver bars so they can use them in their electronics or their solar panels or in jewelry, well, the price goes up, right? So this is a significant support for the silver price, the fact that we are in this structural market deficit. And every analysis that I've seen expects this to continue. Even though the prices are rising, silver mining is very inelastic, meaning that it doesn't really respond quickly to changes in price. So even though the price is going up, it's more lucrative to mine silver. You're not going to see that silver output quickly correspond with that price. It's just the kind of the nature of the beast. I mean, think about it. If you have a silver mine, it's not like you can just go tomorrow and say, okay, I'm going to dig more silver, right? You have to have the infrastructure in place. You have to have the equipment, and you have to find new deposits. So all of these things take a lot of time. Mining is a very long timeline business, so it does not respond quickly to changes in price. All of that to say is that there's no indication that the supply shortage is going to drop anytime soon, and it appears that demand is going to continue to increase because silver is really the best metal when it comes to electronics. In terms of its conductivity, in terms of, it's easily made into wires. It's perfect for electronic applications. So, and we're using a lot of electronics. Think about all of the new computing structures that are being developed right now for AI. All of that requires silver. So this demand on silver is not going anywhere anytime soon. And speaking of demand, industrial demand set a record for the fourth straight year in 2024. So we've seen progressively increasing demand for silver. The green energy movement is pushing this demand as well. We have a lot of solar panels being made. A lot of solar energy is happening, and that all requires silver. And it's interesting because one of the things that I've seen noted, and I've actually kind of thought of this myself, a lot of this green energy stuff is being supported by governments, right? It's being tax subsidized, and we can argue whether or not that's a good thing or not. I personally don't think it is, but be that as it may, that's what's happening. Governments are supporting the solar industry. They will continue to do so. The whole green energy thing is it's an important thing in the minds of a lot of politicians. So I think that even if we have a recession, I think that the fact that green energy is going to be supported will help keep the silver price boosted, along with the investment demand that will come in. I'm going to get to that here in just a second. But even before the tariff-related outflows that I was talking about a minute ago, physical silver was already moving out of London. So it wasn't just tariffs, all of this suddenly happened. It was already going on. Silver holdings actually peaked back in 2021 at 1,180 million ounces. That's the amount of silver in London. By the end of last year, that was down by about 30%. We've also seen outflows of silver from COMEX and Shanghai Futures Exchange vaults. So what that tells you is that people are getting physical metal, right? Instead of just floating these future contracts and letting them move on, making a new futures contract, people are actually taking possession of the silver. Metals Focus notes that release of these above ground stocks has helped keep the physical market well supplied in recent years. So that's what I was talking about earlier, when you have these structural deficits in the silver market, the silver users, and I'm talking primarily industrial users and jewelers, they have to access silver. So they're going to come into the COMEX and they're going to, get into these futures contracts, and they're going to take physical delivery of the metal because they need to use the metal. So that means there's less metal sitting in these vaults to back up all of the investment silver that's out there. Okay. So strong demand for physical silver in India has really contributed to this drawdown in silver stocks. Silver jewelry and investment demand have remained strong despite a series of record highs in rupee terms. Demand is expected to remain robust as the country enters into the wedding and festival season. I mention India because India is one of the largest silver consumers in the world. We think of India as being the gold country, and they do love gold, but they also love silver. And it is a very strong driver of global silver demand. So very significant that we're seeing this strong demand in India right now. Metals Focus pointed out that even though there is plenty of silver in London, right, we're not running out of silver. About 80% of it is held against physically backed silver ETFs. And that's the highest share since the LMBA vault data became available back in 2016. Metals Focus said, quote, "In other words, only 20% of London stocks, that's less than 170 million ounces, were available for lending or mobilization at the end of July. With further ETP inflows recorded in August, this may help explain why physical supply has remained relatively tight." So you've got all of this investment demand, particularly in Asia, for silver. So that means silver is flowing into these ETFs, these electronically traded funds. They're backed by physical silver, so that physical silver is supposed to be held in these vaults. Nobody else can touch it. You can't lease it out. It's supposed to be committed to these ETFs. We only have 20% of the London metal right now that's available. So that just shows you how tight the supply situation really is. Again, we're not about to run out of silver, but at some point, what happens when those above ground stocks become even more depleted? Again, you're going to have to see that price go up and up and up to continue to supply the needs of the market. So, talking about the silver supplies in the industrial area, there's still plenty of untapped demand out there in the marketplace. So we've got significant industrial demand, but there's still a lot of untapped investment demand. And despite the rising prices, investor activity has remained subdued in key sectors, particularly in the United States. Both the CME in the U.S. and the Shanghai Futures Exchange report declines in the number of silver futures contracts. Meanwhile, the CFTC reports show that as of the end of August, net managed money longs were about 1/3 below June's highs. According to Metals Focus, this decline in investor positioning can be partly attributed to elevated macroeconomic and geopolitical uncertainties throughout the year, which have diverted attention toward gold. So as the gold prices hit these record highs, a lot of investor attention has been focused more on gold. I think it's interesting dynamic because, at some point, investors are going to start to say, you know what, gold is a little bit expensive. Look at silver over here. Not quite as expensive. Maybe we should turn our attention to that. I think you're going to start seeing that happen more and more as the gold price continues to rise. Lower investor interest is also manifested in the physical markets. Silver coin and bar sales have shrunk so far this year, which may be a little bit surprising to folks considering the fact that we've had, a 40% increase in the price of silver. But on the other hand, it does make sense a little bit because people that are price sensitive aren't going to buy when the price is going up. And there has been a lot of selling as people kind of try to book profits. But the Silver Institute data shows that weak demand in the physical silver investment market is almost entirely being driven by Americans. Asian demand has actually been robust. I've already mentioned India. European silver demand has shown signs of recovery this past year, although it is coming off a relatively low base. However, here in the United States, we've seen investors taking advantage of higher higher prices and selling to take a dollar profit. And this is very similar to the dynamic in the gold market, where U.S. investors have also remained on the sidelines and have been doing a lot of selling. I actually talked about this in a show, I guess it's been 3 or 4 weeks ago. This kind of, I don't know, it doesn't make sense to me, right? We're in a situation where we have a rapidly declining dollar. Our purchasing power is being stripped away from us on a daily basis. And yet we have people out there that are thinking, oh, let's sell our silver and gold, our real money, for these fiat dollars. Now, I get it. If you've got bills, if you've got things that you need to buy, sometimes you got to do what you got to do, and it may be a good time to liquidate for some folks. But I think by and large, if you're just holding silver and gold as a long-term investment, as an inflation hedge, you don't want to sell your inflation hedge right now because, ladies and gentlemen, we are running headlong into a period of protracted inflation, in my opinion. I don't think the inflation situation is going to get any better, no matter what the CPI or the PPI or whatever government data they want to throw at you. I've noted before that inflation is the policy, right? Even when there is quote unquote no inflation, it's running at 2%, right? They're stealing 10% of the value of your purchasing power every 5 years. So I don't know why people are selling their inflation hedge. I think some of it goes back to what I talked about on the very top of the show and what Jesse Colombo addressed, that there's just this nervousness. It's too good to be true. We better sell before the price crashes. And again, you have to ask yourself the question, what dynamics are in place that would make me think we're about to have a sell-off? If you can make that argument, then maybe it's time to sell. But if it's just because, oh, I'm scared, don't let fear drive your decision making. So anyway, according to the Silver Institute, retail silver investment is down about 30% in the U.S. right now. So I think that's significant in this way. When U.S. investors finally do get into the game, what's going to happen? We're going to see another big surge of investment in silver, and that could drive prices even higher. During a recent interview, Money Metals CEO Stephen Gleason called $40 a key level, and he said that with gold prices already at record levels, silver will become an increasingly attractive option. I just mentioned this a few minutes ago. Stephen wrote, people will start looking at silver as a bargain, and even though it's at $45 or $50 or $55, I think it's going to gain momentum, and especially if it gets over that $50 price. I do think that we're going to be challenging the $50 level by next year, so we'll see. And then if it breaks, and I think it breaks through that, it's going to go quite a bit higher from there. And, the technical analysis backs up Stefan's assertion here. I've talked about before that if you look at a silver chart, it has what is known as a cup and handle pattern. You have those two all-time highs in the 80s and then in 2011. Those are the top. You draw a line between those, you end up with a cup, and then you have this handle off to the side where we've had this consolidation. That cup and handle pattern is very predictive of a huge breakout. And the longer that cup, the longer time span that the cup and handle pattern plays out, typically the bigger the breakout. So we had this huge cup and handle pattern that would indicate a huge breakout. So I think that's part of why Stefan is thinking once we hit that $50, once that breakout happens, there's going to be a significant upside even from there. Metals Focus also remains bullish on silver. Those folks wrote, looking ahead, the factors constraining liquidity in the London market are likely to persist in the short term, and so will continue to deliver price support. The investment case for silver and gold is also expected to remain compelling well into 2026. Anticipated interest rate cuts by the Fed from September onwards should reduce the opportunity cost of holding metals. Additionally, a global economic slowdown, concerns over the Fed's independence, and rising anxiety about the U.S. debt levels should all support gold, and by extension, this will spill over into the silver market and drive further investment and eventually also price appreciation. Now, you might be thinking to yourself, Mike, this is all well and good. I'm sold. I want some silver. What's the best way to invest in silver? Well, let me suggest junk silver. Now, don't let the name fool you. Junk silver is not junk. What I'm talking about is U.S. dimes, quarters, and half dollars that were minted before 1965. Now, you might be thinking, Mike, why would I want to buy quarters, dimes, and half dollars? A quarter, it's 25 cents. What could that possibly be worth? Well, these pre-1965 dimes, quarters, and half dollars are 90% silver. Did you know that the melt value of a 1964 or earlier Washington quarter right now is around $7.39? So no, it's not just a quarter. A quarter is not just a quarter. If you have a silver quarter, it's worth $7.39, which gives you a really good indication of what the government has done to your money. Right? It has devalued your money. This is no different than when, the Romans clipped gold out of the coins to make them lighter. It's the exact same thing. That's exactly what the U.S. government did. But like I said, these old silver coins are not junk. And at the recent peak of retail buying, demand for these junk coins, these silver quarters, dimes, and half dollars, demand was really hot. And ask premiums for this junk went north of $15 an ounce over spot. So you were paying a significant premium to get junk silver just a couple of years ago. But today, dealer inventories are overflowing, and these ask premiums are actually south of $1 an ounce. So you can get this junk silver with an extremely low premium, which means that you're putting more into your investment. You can get junk silver at Money Metals. I'll link to the product page on the show notes, or you can search the website and find them. Just put junk silver in the search bar. Or if you have questions or want to know more about what is Mike talking about on the show, give them a call, 800-800-1865, and talk to a precious metal specialist over at Money Metals. Have you ever wondered why they took the silver out of the coins? It's just another example of monetary devaluation, like I mentioned. The Romans used to clip coins, or they would melt them down and make the gold less pure so that there's not as much gold. So each coin still looks the same, still has the same 25 cents or whatever on it. And obviously, they didn't have 25 cents on Roman coins, but you get my point. But it was less valuable in terms of the gold or silver. I guess this goes to the point, back in the day, money was worth something. Literally. Coins were made out of gold and silver. Paper money was at least backed by physical metal. Today, fiat currencies are just worthless paper. They're backed by, I was going to say nothing, but actually they're backed by the full faith and credit of the U.S. government. Woo! I don't know about you, but that's not worth a whole lot to me. Now, if you want to know who to blame for removing the precious metal out of your money, you can blame Lyndon B. Johnson. It's his fault. He signed the Coinage Act back in 1965, and when he did, the U.S. Treasury removed all of the silver from dimes, quarters, and half dollars. So today we have coins that are basically made of copper with a kind of a nickel alloy on top of them. So they're not worth nothing, but certainly not worth silver, right? If you have a modern quarter, it's worth 25 cents. It'll buy you, pretty much nothing. I don't know. Maybe you can get a gumball for a quarter nowadays. But again, if you can find one of those pre-1965 quarters that are 90% silver, well, then you're talking about, over $7. So again, this just really illustrates the devaluation of your money. Now, ironically, President Johnson promised that removing the silver would have no impact on the value of U.S. coinage. He asserted that, quote, "The Treasury has a lot of silver on hand, and it can be and it will be used to keep the price of silver in line with its value in our present silver coin." Yeah, no. The value of your coin is now useless. So shocking he was lying, right? Richard Nixon actually told a similar fib when he severed the last ties between the U.S. dollar and gold. When he announced the closing of the gold window back in 1971, Nixon said, "Let me lay to rest the bugaboo of what is called devaluation." And he promised, "Your dollar will be worth just as much as it is today." Yeah. As we all know, that's not what happened. The dollar buys a fraction of what it did in 1971, and U.S. quarters minted after 1965s are virtually worthless. That's why you want real money, gold and silver. And we can help with that. And not just junk silver, although that is a great way to expose yourself to silver right now. But we can help you with gold. We can help you put gold and silver into your IRA, physical metal. Yes, you can actually hold physical metal in an IRA. We can help you store your precious metals. We have a wonderful installment program where you can build your gold and silver portfolio over time, just with as little as $100 a month. So there's a lot of things that we can do to help you here at Money Metals, but you got to give us a call. 800-800-1865. Talk to a Money Metals, precious metals specialist today. If you don't want to talk on the phone, you don't have to. You can go to moneymetals.com and you can chat with the precious metals specialist right online in a chat. Or, if you know what you want to get some of that junk silver, just go to the website, find the product you want. You can order online. We'll ship it to you. Easy peasy. But do it today because, your money is going to be worth less tomorrow than it is right now. Your dollar is going to buy less tomorrow than it'll buy today. That's just a fact of the matter. So if you're trying to save, if you're trying to preserve your wealth, you want to have real money, silver and gold. Again, the number is 800-800-1865. 1865. So give us a call today. So that's a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, you can sign up and join the 1 million, yes, I said 1 million people who are on our email list. Of course, you can subscribe to the Midweek Memo podcast on your favorite platform. And when you do, you'll also be able to tune into our Market Wrap podcast that airs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and other interesting people from the world of gold, silver, economics, and investing. Again, I thank you so much for listening to the show. As I said earlier, please like, share, give us your love, and help grow the show. Thank you so much, and I will be back again to chat with you next Wednesday.